All right, guys, we've got several coming on, 7, 8, okay. Good, we're over 10. So there's several people coming on. I'm going to give it just another minute for people to log on because some people aren't familiar with the system and it's new. And then we'll get started and jump right into it. This will be fairly quick and tight. It'll be about 40 minutes. And then we'll have some time for question and answer at the end if there are any. And there usually are. Let me see if questions. Opening the question box just to make sure it works, and it does. So, yeah, beautiful time of year, first of the year, tax returns coming, etc., to start looking at buying a home. So it's definitely the right time of year for that. Cool. So got some more on. That's good. Welcome if you just jumped on. I'm going to drink some tea so I don't cough. This time of year causes, I don't know, some kind of cough, I think. So, okay, we'll just give it another minute here, see if anyone else jumps on. And as I do, as we get started, we'll just keep on going because there'll be time for questions at the end. If a couple jump on our large group, I'll maybe stop and just say hello. But one more. Okay, good. All right, so let's get going here and just jump right into it. And thank you for showing up this evening. I know it's a cool evening. It's probably a good evening to have your favorite drink. I've got chamomile tea or some kind of tea. And learn about home buying. And what we're going to talk about is what it really means to build wealth, as well as building memories in your home, choosing the right realtor lender, and then a little about credit scoring, down payment, etc. So just an overview with the idea to answer the big questions, just so you have a bigger picture of what is this, a home buying thing, the whole process. And then as you get more into it, we can get more specific to everyone's specific situation as well. So this is Home Buying 101. And what I like to call it is where, hold on one second. It's not seeming to move. Where desire meets belief. Because, yeah, sure, we want to own a home. We desire to own a home. It's kind of a dream for some people for a long time. But then, can we really do it? It's getting enough information and it meets the belief. And I'll tell you, this was important for me before I got into the mortgage business. I've been 18 years doing this in the mortgage business, and I love it. And because I get to help so many people achieve that dream and really build wealth and the memories. And it's great. It's just an awesome thing to do. But I bought my first home before I got into the industry. And I remember looking for the home was great, finding the right, we built, so finding the right lot and picking out, going to the design center and picking out all the amenities, etc. was terrific. I didn't do much of it. My wife did most of that part, of course. And but the process of getting a home loan, and welcome if you're just joining us, the process of getting a home loan kept me up at night, seriously, because I didn't know I didn't even know the questions to ask. I just made application and answered the questions and then just waited days in that case and wondered, am I going to get I remember laying awake at night, staring at the ceiling going, I don't even know if we can do this. I don't know what's involved. Are we even going to get approved? And I didn't know because I didn't know what went into it. No one told me that, and the internet was brand new and didn't even think of going on there to look because I wouldn't have found much, I'm sure, at that point. But I had the desire, and I jumped in with blind faith. What I want to do here is have you jump in, but knowing enough that you're confident moving forward. That's the whole goal. But first I want to help with one thing, and that is everyone says buying a home builds wealth over time, but a lot of people don't know what that means. And in fact, most people don't know what that means. But the average net worth, and I'll start with just a generic fact, the average net worth of a homeowner in the United States is 44 times greater than that of a renter. So what that means is if you want to be the big dog and use this as leverage to build wealth, the way to do it is to own a home, not to rent, right? It makes sense because you're building wealth in an asset over time. But let's look at some real numbers for a moment before we get into the process itself. The real numbers that every 3 years, the Federal Reserve does a study of homeowners as opposed to renters. And it's a more comprehensive study than that, but that's one thing I love to pull out of it. The last one was done in 2016. And so we're due for 2019 to be published in time, but it hasn't been yet. So I'm going off the numbers from 3 years ago. And the average homeowner in the United States had a net worth of just over $230,000. The average renter had a net worth of $5,200. So a huge difference. And a lot of that is building equity with appreciation and with paying down the mortgage over time. Let's look at that. Oh, there. So here I'm comparing buy versus rent. So I'm saying someone could be renting for about $1,500 a month, which I think is a fairly average rent, maybe even below average at this point. Or they could buy a home for $280,000, something that's highly doable in this market. As you can see, over time, and let me move this out of the way a little bit, over time, specifically 9 years. And I chose 9 years because the average homeowner is in a home for 9 years. So obviously it's a 30-year fixed rate mortgage, et cetera, and you could be in there your entire life, but I'm just choosing the average just to run those numbers. The cash flow difference over time goes in favor of home ownership, even though you're factoring in for, someone else, welcome if you just joined us. Even though you're factoring in for maintenance or repairs, in this case, $116 a month goes into savings and comes out of savings when the hot water heater breaks down or you need a new dishwasher or something like that, which does happen owning a home. So you do have to plan for it and budget for it. But we also know that rents don't stay stable. So I predicted a 3.5% rise in rents year over year. So over the course of several years, even factoring in for maintenance and repairs, et cetera, the average rent is going to exceed this mortgage and the repairs, all the cost of home ownership, basically. So it's going to go up to from $1,500 to almost $2,000 over the 9 years if the 3.5% increase holds true, of course. So the cash flow difference over that same 9-year period is closer to $16,000, $15,000 and change. And the homeowner, the person who bought the home, gained $53,000 in appreciation. That's projected. That's by the National Association of Realtors. We know that home prices have been appreciating here in the Charleston area at a higher rate than that, at about almost 5% for the last several years. But that's not sustainable. Well, everyone knows that. But I don't think it'll go down either. It would take a lot to do that. 2008 again, which is not on the books or the horizon. So at a 2% appreciation, you would have gained over those 9 years a little more than $50,000 and paid down a little less than $50,000 in just paying down the principal in a fully amortizing mortgage, right? 30-year fixed rate. So what's that mean? Well, it means, let me move this over to this side for a moment. It means the net gain by owning a home over that 9-year period, remember, is about $90,000. But this is important because I get some people saying, well, I want to buy a home. Not so much anymore. It did happen in the past when homes were appreciating a very rapid rate. I get some people saying, well, I want to own a home just for a year or so and then move. And there I would caution because remember, there's closing costs going into it. There's the 6% selling fee to the realtor going out when you sell a home. So this is factoring all of that in. And you can see, I don't know where my mouse is, that if you were only to buy a home and own it for a year or two or even 3, you're probably going to lose money over renting. So this isn't a short-term play. If you're going to own a home, you kind of want to make sure you're going to be there for a while. By year 4, you're $5,000 to the better, and then it just keeps getting better and better and better years 4 through 9. But again, is there a case to be made for renting? Absolutely there is. So everyone should not be buying a home. If your job is going to likely transfer you out of state in the next 12 to 18 months, you're probably better off just renting for that period of time. If, on the other hand, you're fairly stable and you're settling and this is going to be your home for a while, yes, I would absolutely recommend you look into buying at least. Here's the other great side of that. It's not just a wealth building tool. It's when memories are made. And sure, we can make memories. We do when we're renting in an apartment or something. But when the kids come in and jump on the bed early in the morning and wake you up and everything and roll around on Saturday morning, it's just nicer when it's your own home. And I can say that from fact. It's fun. It's enjoyable. You get the cameras out. You record the memories. It's your place. It's different. So there's that side of it too, which is intangible, but it's very real as well. All right, so let's get into the act of home ownership. You know, how do you do it? What do you do? So first, tips for finding a real estate agent. One of the things, so you want to really find a real estate agent that knows your area, the type of home that you're looking for. If you're looking for a condo, not all agents know condos the way someone who maybe has a lot of experience with condos knows them, and they're different. So if you're looking for, you know, large tracts of land or lake property or something like that, you want to focus in on the right agent that really knows the area, is a good negotiator, has a lot of experience. And here's what I'll say. So a lot of you are here this evening because you got an invitation from a real estate agent. And I would highly recommend that you go talk to that real estate agent first and foremost. And here's the reason why. I don't give that link to invite you to every real estate agent. In fact, it's a handful. It's very few. So if I have, it's because I've worked with them. Their reputation is stellar. I know that they're a good negotiator, generally a very good listener, and they're going to listen to what you want and need in a home. And we'll talk about that in a moment. So I would highly recommend just go back to the agent that you are, that sent you that link, because they're handpicked for a reason. I don't, in other words, I didn't mass send out the links to invite you to this. It was by design. So I would absolutely at least give a shot to that realtor. And okay, so the tips for finding the right lender. Well, as you probably guessed by now, I am a lender, and I hope that I will be your lender and you'll choose me. But here's what is important. A home is a big investment. You want someone who's not just going to push you into something, the loan that makes sense for them, the easiest one to get done, maybe something like that, but really shows you your options and takes an educational approach to preparing the home loan and making sure you're comfortable and understanding the costs, the fees over time, property taxes, insurance, the homeowner's insurance, but also title insurance, which is something not many explain, but it's very, very important. It's a one-time fee, and we'll get into that later. So you kind of want to make sure they're a good financial fit, if you will. A little about Atlantic Bank, because I'll give a very brief commercial for myself and my company at the moment. We're a mortgage banker, a direct lender. We underwrite in-house, so we tend to have extremely competitive rates, and more importantly, communicate a lot during the process and close on time. It's a very smooth process. I love working what I do, partly because everyone, from the underwriter to the closer to the processor, everyone is focused on the closing date on that contract as being sacred, something that you have a whole life that has to move on that day, and we have to make sure that it's ready. So enough about Atlantic Bay. I hope you choose the right lender, and again, I want to be in the running. Then you start the home buying process. And so a lot of people start online, of course, and I would, just to get a feel for what's out there, the prices, the price points, the neighborhoods. It's a good place to start. It's not necessarily a good place to end and choose a home. Sometimes they look really, really good on Zillow, but then you go see the neighborhood, drive to the area, and you realize the commute's a little too far, it's a little too, or whatever the case may be. That's where I would have a new home wish list. And that is new used home, right? In other words, a resale or new. But a wish list. What do we need to have in a home? And what would we like to have, but it's not absolutely necessary? And the reason I would suggest that is because I've seen so many first-time buyers see a home and just assume that it's going to be there a week later. and it's not. If it's priced right and it looks well and it's in good condition, homes are going very quickly. Even now, it's January as we're doing this, of course, and I'd say that because we're recording it for later. So it's January. It's typically a time where not that many homes are on the market, and homes sit for a longer time. I don't know what it is about this January. I think the economy is just doing very well, especially right here locally, and we know real estate is local. So, and things are going quickly. There's multiple offers. There's bidding wars. Sometimes you want to be ready to jump on it if you do find the right thing that fits all your criteria. And the only way to know that is to not just go looking at homes, but have real specific criteria. If it's just you buying, write it all down, what you need to have, what you'd love to have, but not absolutely necessary. And if it's a couple, all the more reason. Talk it through, write it down, and come to an agreement. Before you make an offer, by the way, unless you're paying cash for the house, you need to have your loan conditionally approved. And that I can help with because you need a pre-approval letter or a full commitment letter. Sometimes we'll fully underwrite the loan, give a commitment letter. Either way, an offer just simply won't be accepted by the listing agent or the seller if you're not pre-approved for your mortgage ahead of time. Makes sense, right? Because no one knows if you can buy. There's nothing to prove that you can actually close and buy on that home. So why would they take it off the market if you're not? Before you make an offer, or as you're preparing to make an offer, you need to know what's negotiable. And this I would talk over with your real estate agent as you're interviewing that agent to get a feel for what they are seeing in the marketplace as well, because it changes from time to time. So obviously, closing costs are a big part. I see a lot of sellers paying closing costs on these homes. And it's very common, but it has to be negotiated that they agree to stuff to pay closing costs. So let's give a quick example of that. Let's say a home is listed for $250,000. You could come in and offer $245,000 and get $5,000 knocked off the price and get a pretty good deal compared to what they're asking. Or you could come in and offer $250,000, but also that the seller pay $5,000 toward your closing costs, which on that purchase price is all your closing costs. The net to you is $5,000 less out-of-pocket cash that you have to come up with right now. The net to the seller is exactly the same. They net $245,000. So talk that through. Then there's other things like a home warranty. In case some major thing breaks down on the home within the first year, the home warranty can come in and help pay for that or fix it, cover the cost of fixing minus a small deductible. Sometimes do appliances if they're taking them with them, etc. Appliance package or something. Repairs. Now that's a big one. So you want to have a home inspection. Your realtor will talk to you about that as well, and probably recommend a good inspector if you don't have one. And some things you want to ask the seller to repair. Some things are just minor little things that your punch list is your punch list as you get into the house, etc. And we talked about closing costs. So kind of get creative about that. You can get a pretty good deal sometimes if you just get creative, see what the seller really wants out of the deal and what you really want out of the deal. And sometimes you can get some creative things going and get a pretty good deal. Pre-qual. So what do you do when you get pre-qualified or pre-approved, if you will? Pre-qualified is where we might quickly have a conversation, maybe pull credit, and just talk through what do you make? Oh, that's your income. Okay, how much do you have in the bank? You have $10,000 in the bank. Okay, great. That's a pre-qualification because I haven't seen anything, right? A pre-approval is where you actually supply the documentation. Here's 2 months bank statements. Here's my 2 most recent pay stubs. Here's maybe some tax returns, etc. And we review those and say, you're good. You're pre-approved. Haven't been through underwriting yet. You're not fully approved, but you're pre-approved because we've seen everything. We've documented your income, your assets, your credit. So that's what pre-qualification really is. It's pretty quick and simple. I wouldn't sweat it. And we'll get into credit in a minute. The biggest thing people sweat, well, the biggest 2 things really are credit and cash to close or down payment. And we'll talk about those things on a later slide. But just starting the process is most important because then we can set a plan to quickly get there. if we need to, if we're not right away. But before we get to that, the loan programs. So what types of loans are you going to apply for? It depends. But conventional loans are probably the most common. Actually, it is the most common. It's what I do the most of. And that's a Fannie Mae or Freddie Mac loan. So they require 3% down payment, not 20%. That's what a whole lot of people think. I know. People think that all the time. It's not 20%. It's 3% for conventional loans. Yeah, we've got more participants. Thank you for joining us. USDA loans are, the other name for that is rural housing loans. So the property has to be considered rural. So you're not going to buy downtown Charleston because the property is not considered rural, so therefore it doesn't qualify for that type of loan. You could buy in some of the outskirts of Somerville, some of the outskirts of Moncks Corner, certainly closer to Orangeburg and things like that. Those properties qualify for sure. There are also income limits on that, and it's per county. So we can talk about that as household formation, how many people in the household, et cetera. And but it's somewhere in the neighborhood of $75,000 to $80,000 for most people in our area. If you make above that, you don't qualify for USDA loan any longer because you're above the income limit. VA loans, obviously, you probably know this, you have to be active duty or a veteran or work for the DoD, et cetera, a couple other things, and you qualify for a VA loan. If you do, it's 100% financing, no down payment needed, and it's a really easy loan to qualify for. I love VA. FHA is also easier to qualify for as far as credit score-wise. This one's not 3% down, but rather 3.5%. So on a $200,000 loan, a $200,000 purchase price, just to make simple math, if you bought it with a conventional loan, you would need 3% or $6,000 down payment. If you bought with FHA, you'd need 3.5% or $7,000 down payment. Then there are some down payment assistance programs. Freddie Mac just came out with a really neat program. Also has income limits, but it's a really very simple program to qualify for. And then there's jumbo loans. Anything above $510,400 is considered jumbo, meaning it's not sold to Fannie Mae and Freddie Mac. It's not a conventional loan. It's sold to a bank, sometimes more frequently a hedge fund or something like that. So it's different qualification criteria. And generally, a larger down payment, usually at least 10%, some require 20%. Again, we kind of mentioned this, but I like to see it graphically. Low and no down payment options. So FHA, we said, requires 3.5% of the purchase price as a down payment. Pardon me. Conventional loans require just 3% down. Again, not 20%. I know that's a falsehood out there, and it's completely false. The VA is 0% down, and there's no limit on that anymore. I mean, every lender puts their limit, but it's $1.5 million or something like that. You can get into with a VA loan 0% down now. That was just as of January 1st of this year. It changed. There used to be a limit. And USDA is also 0% down, but again, house has to be considered rural, and there are income limits. If you fit in the box, it's a really, really good loan. We don't do as many USDA because there's so many criteria that all have to fit together perfectly. But if they do, it's a good loan. Oh, sorry. There we go. Okay, now to the question of the hour that everyone asks and wonders and worries about is the credit score. What credit score do I need? How do I change my credit score if it's not good enough? What do I do? Am I just out? I can never buy a home? No. The simple answer is no, you're not out. You can buy a home. You might have to work on credit first, but it's pretty simple. Here's the main thing. A credit score is just an algorithm. And it's an algorithm that changes. As soon as you change something, it is kind of a determinant of your financial wellness in a sense. I think a better way to put that actually is your credit score is indicative of how you manage debt. Are you overusing it? Are you paying on time, etc.? And how long have you managed any debt or credit? But as you change something, it doesn't have a memory. There's no memory, so it just changes the score. The algorithm changes. And I've seen people go up as much as 100 points in a very short time, like within a couple of weeks sometimes, or less, actually. And we can help with that. So the credit score is, they go from 300 in one scenario, 350 really, to 850. 300 being a very, very poor score. I've never seen that in real life. I don't think it exists in the wild. I've seen high threes, and it's hard to get there. You have to really work to have bad credit in the high threes. Again, even if you start there, you can still fix it. It might not take 2 weeks, though. It might take 8 or 9 months. If you were in the low 500s, you know, it'll still take a little bit of time, but we can set a plan and get there. We can do loans. I can do loans as low as 500 credit score, but you're going to have a hefty down payment and not a very pretty interest rate. I don't like to do those in most cases. I'd rather work on credit first and then get you into a home at a much lower interest rate and a much lower down payment, if necessary. At 580, I can do FHA and VA up to 620, but there's going to be a few more overlays, a few more hoops to jump through to get approved. And I'll walk you through those. It's things like verifying rent was paid on time for the most recent 12 months. It probably has to have a couple of months reserves, meaning if whatever the new mortgage payment is going to be, let's say it's $1,000 a month, you have to have $2,000 in the bank that's not used for closing, that just sits in the bank. That's your first 2 payments sitting there, because it's a little more risky, so lenders want to see that you have a little bit of cushion. You're ready to make the first couple payments. 620, we can do conventional, requires 620 or above. So does USDA. And VA and FHA are just an easier approval, 620 or above. And then 680 or above, you're going to get a much better interest rate on conventional. And then 740 to 850, 740 and above is considered perfect credit in the conventional lending world, so you get the best rate. So if you have a 680 as opposed to a 740, should you wait to buy? Not necessarily. I wouldn't, because there's FHA loans which have a much lower interest rate. Conventional is going to be a slightly higher interest rate than if you had a 740, but we're talking an eighth to a quarter. On a $200,000 loan, we're talking probably $20 a month. Probably not something that will stop you from buying, although it would be nice to have a 740 and save $20 a month, but it's not a make or break thing. You see what I mean? I hope that makes sense. Okay, I'm having trouble with the controls. So the credit score. What makes up a credit score? And let me pull this over here real quick, again, to the other side. So types of credit and credit inquiries are the two least things that make up the score. The credit bureaus do like to see a mix of credit, you know, a couple of credit cards, maybe a store card, maybe a car loan, either current or paid off in the past, but a recent car loan, or maybe, you know, student loan or mortgage, obviously, will help. That's a different type of credit. So, but I wouldn't go out and open new credit until we talk it out, until you talk to your lender, because there's things that will help and things that won't help. And there's also that debt ratio. So if you go out and buy a new car, which I've had people do actually, it certainly helps your score a little bit once it registers as paid on time, but it doesn't help your debt ratio at all. So it helps you qualify for less home. So let's talk through that. Types of credit are the least thing, as well as credit inquiries. Everyone worries about that. Will it affect my score? Yes, it will. When I pull your credit, it's a hard inquiry. And it will affect your score, but it's the least thing that affects your score. So in my experience, it's somewhere between 0 and 2 points generally is what it will affect the score. And the lower the score, the more it affects it, though. So I've seen if your score starts in the 400s, you might drop as much as 5 points on a credit inquiry. But we couldn't really do the loan anyway, so we're going to set a plan to get you there, etc. So it's kind of one of those catch-22s. I'm not too worried. I wouldn't be too worried about inquiries if I were you, as much as these other things. Now, length of credit history is a bigger part of your score, and that's where some people make the mistake. Length of credit history is how long have you had a particular trade line open, active, and paid on time. And so what some people do as they prepare to purchase a home is they'll pay off credit cards and close them, thinking they're doing a good thing. They're eliminating debt, and then eliminating the possibility of bringing on more debt, right? So it makes sense, except it doesn't, because it eliminates all that length of credit history that you built up. If you've had a credit card for the last 10 years, paid on time for the last 10 or 5 or however long, that's a long credit history. If you close that, that just went away. So your score is going to drop. So what I recommend is pay the credit cards off if you can and you're able, because that will help, but leave the cards open. When it comes to a car payment, you're going to pay it off to help qualify. You can't leave it open, so don't worry about it. You can't do anything about it. It's better to pay it off. Outstanding balances is a huge one. This one is big. So the outstanding balances mean, especially in credit cards, right? So if you have a credit card with a limit of, let's do simple math. Your credit card limit is $300. And let's say you have charged $300. So you're at your limit. And let's say you went over and you charged $302. So you're over your limit. It's going to tank your credit score. It's going to destroy the credit score, like as much as 100 points or more. So what you want to do is the credit cards especially, as you're applying for a home loan and preparing for that, try and have your credit cards paid down to 30% usage or lower, right? So don't close the credit cards. You can pay them off. The credit bureaus say carry an 8% balance. So if your credit limit is $1,000, you would carry an $80 balance month over month, pay it off on time, etc. It doesn't help your score that much. I would say just pay it off. Just use your card. You have to use it from time to time to help your score, but then you have to pay it off. So don't carry a big balance. In fact, no balance is better than a large balance. Does that make sense? And payment history, obviously, is the biggest one, and that is, do you pay your bills on time, right? Do you have any late pays, 30, 60, 90-day late? Do you have any collections, any charge-offs, anything like that? And I'll tell you, one of the most common things that I see are medical collections. I don't know what it is about medical billing companies, but they tend to send stuff to collection before they send it to you, I think. So a lot of people end up with small little medical collections, and they do hurt your score. We don't take them into account generally when I'm qualifying you for a home loan, but they do hurt your credit score. Here's the trick. If you have some little medical collections, one thing you can do is go to pay them, but ask if you can pay for deletion. Again, pay for deletion. And a lot of medical companies collection companies will do that. They don't have to, so you can't force them to, so it's their choice. But if you don't ask, the answer is going to be no. But if you ask, sometimes the answer is yes. So pay for deletion means you agree to pay the bill. They give you something that says, hey, you know what, this shouldn't have been a collection in the first place. Take it off the credit report, and your score goes up. So it's worth asking. Again, can't make them do it, but it doesn't hurt to ask either, because the answer could be a very good one, like yes. The other thing we can take into account when factoring your how much home you qualify for is your debt to income ratio, or your debt ratio, right? How much debt do you have? Generally, it's the new mortgage, the proposed new mortgage, plus anything else monthly payment that shows up on your credit report. So the minimum payment on your credit card, your car payment, your student loan payment, plus the new mortgage payment, and that includes principal, interest, taxes, and insurance. How much is that as a percentage of your gross income? That's pre-tax income, right? There's tax benefits for owning a home, which are less now, but still exist. And so that's why we use the pre-tax income. For someone who's W-2, factoring the income is very, you're on a $60,000 a year salary, that's $5,000 a month. We can factor the income very easily. It's $5,000 a month. For someone who is, say, a waitress and gets a lot of tips, or a waiter or a bartender on commission, or a car salesman on commission, or something like that, the income fluctuates from week to week, from month to month, from night to night, right? As it may be. So what we do there is we can't see what it is today going forward. The only way we can really factor income and see how much income we have to use is go backward. So we go backward 2 years. Same with self-employed people. You own your own business. You know that your income fluctuates a little bit from month to month, sometimes a lot. So we go back 24 months, add up all the income, divide by 24, and say that's a monthly income that we can count on going forward. So again, if you're self-employed, on commission, a bartender, anything like that with fluctuating income, we have to go look backward and see what's a reasonable amount going forward. What's 24 months income divided by 24, what's your average there? And that's reasonable going forward because we don't have anything else to base it on. If you're W-2, if you have an hourly wage of $16 an hour and you work 40 hours a week plus maybe some overtime, it's easy to calculate your income going forward. So we don't need to look backward. Does that make sense? So if someone starts a new job, this is a question I get asked a lot. Well, I'm about to start a new job. I just quit this job. I got transferred or something. I'm about to start this new job. How long do I have to be on the job until I can qualify? Generally, if you're in the same line of work as you were before, you're just transferring to a new state and a new employer or something like that, but a similar line of work. You're doing same type of thing, and it's a W-2 position. You get a set hourly wage going forward. You don't have to be on the job any amount of time in most cases, right? Unless there's a job gap or there's a few exceptions. We can talk through that individually, but generally, the day you start the job or the day you get that job offer and we know what it's going to be, that's the income that we use, and we go calculate it from there. You do have to have a 2-year history of either studying for that position in school or working a similar type job. So we'll look at the job history and the history of working, right? That part makes sense. So how much home can I afford? Generally speaking, well, I like this. 50% of your gross income can go toward recurring payments, which include a mortgage payment, right? So we can go up to 50% debt ratio, and then 50% of your gross income. I like to keep it below that most of the time, unless there's other income that we can't really count for qualifying, but we know is coming in. You have a part-time job, you've been there for 6 or 8 months, that type of thing, you're going to continue that. Some people, it makes sense to stretch to take all your debts and go up to 50% of your income. But generally, that's where a spouse is not on the loan, has more income coming in, but we're not counting it toward this home purchase, something like that. If that's not the case, if this is the only income, I like to keep it well below 50% because you can become house poor otherwise, right? You can't do anything else because all your income's going toward paying the bills. 30% goes toward flexible spending, 20% toward savings, hopefully. If you can save 20%, you're going to be wealthy over time as well. So I highly recommend doing a budget that works for that and making the home fit into that budget. What makes up a mortgage payment? It's PITI. Principal and interest, which is your mortgage itself, plus taxes and insurance. And the taxes are property taxes, the insurance is homeowner's insurance, as well as PMI, private mortgage insurance, and flood if you're in the flood zone, which is somewhere around here. So you have to take that into account. And really what goes into a mortgage payment is PITI-A. PITIA, I don't know how you say that. Principal, interest, taxes, insurance, and association fees. If you're in a neighborhood with a homeowners association, even though you pay that separately, we do have to count that as part of home ownership, a real cost. So if you have an HOA of $600 a year, we're going to add $50 a month to your PITI, if you will, to your payment. Closing costs. In general, there's I have it broken up into 4 here, but really I could almost say there's 2 sets or types of closing costs. One is one-time fees associated with closing on the home, and that's the lender fee, the appraisal, the title insurance, the attorney fees, your recording fee to record using owner of record with the county, all the things that are just one-time fees to get into the home. And then on top of that, you have escrows. You're setting up your escrow account, right? Or prepaids, as they're called in some cases. And that is your homeowner's insurance that will be paid for the first year. So if the property burns down in the first year, you're covered and the replacement kicks in, the insurance kicks in to start rebuilding that home, right? Plus about 2 to 3 months extra, and then same with property taxes. And then 1/12 of your homeowner's insurance and 1/12 of your property taxes is generally paid with the mortgage every month. So that when they come due next year, you've already paid in 12 times, and we have the funds sitting in your account like a forced savings account, and we cut the check to the county, or we cut the check to the insurance company, be it Allstate or State Farm or Farmers Insurance, or whoever you choose. Other costs in the process, they're really all included in the closing costs. That, well, all except one. In the closing costs that I just mentioned, the one-time closing costs of the escrows, including the home appraisal, the title search, closing costs, etc., except for the home inspection. Generally, we don't require a home inspection, so I don't have that as a real cost on my good faith estimate or my closing estimate, my lending estimate. But it is a cost that I highly recommend. Everyone thinks you should get one. I think you should get one. So a home inspector is $300 or $400 usually. That's a separate cost, so I would budget for that as well. So you need your down payment, closing costs if they're not paid by the seller, or as much as is not paid by the seller, and a home inspection. Mortgage checklist. This has become so much easier that as you do the loan application, most people do it online. We've got a really neat online application that's intuitive, and as you go through it, it then creates a checklist of items that you can upload to that same application. You can just upload them online. That's 2 months bank statements, 2 years W-2s, the most recent 2 pay stubs, things like that. And other things, if you're VA eligible, what documents do you need for that? If you're self-employed, 2 years tax returns, that sort of thing. But I won't go through this because the online application creates that list, and it's very intuitive, and it's geared directly towards you. It says, you know, if you fill out on the application that you're currently unmarried and divorced, it's going to ask for the divorce decree, right? So it's intuitive. It's going to ask for all the right things and nothing more, which I like. So finally, and before we get to questions, and we will in a moment, it looks like we do have a couple of questions, but I'll get there in a moment. Benefits of buying a home. So first benefit is obvious. There's no more rent. You're not renting anymore. So you're paying you're saving, in our example from one of the first slides, $1,500 a month, or whatever your rent is. Kiss your landlord goodbye. No more paying the landlord's mortgage. You get to start paying for your own home and building wealth. Again, that building wealth part. In our example of a $280,000 home appreciating at 1.95% per year, and you live in it for 9 years, you're going to have about $90,000 built up in equity. Huge. Over and above your earnings and savings and investing. And it's the place where you can create memories, which is priceless. So it is special having your own home to live in where you create your own memories. And it just sets it apart. It's a little bit different. So getting approved for your home loan, free. Priceless, actually. Should have changed those two around. But I would encourage you, before we get into questions, if you are interested in purchasing a home, let's go ahead and get the process started of getting approved first. If there's any doubt, we can either get you with a credit repair company or just set a plan between us to get the credit where it needs to be or savings where it needs to be for the down payment. You can get gift funds for the down payment, of course. I forgot to mention that. So family can gift you a gift or something like that to cover the down payment. And if there's any real doubt, sometimes I look at a loan file and I'm like, yeah, I think I can get this approved, but I'd like to see the underwriter actually approve it before we go out and start looking for homes and writing a contract. We can do that too. And that's called a TBD approval. The property is to be determined yet, but we can fully credit, underwrite, and approve you, and it just takes the doubt away. I love doing that. All right, so that is me. Let's see if you have any questions, and we do. We have a couple. Bear with me 1 second. No, I think I just mentioned that one. So the question is, what if you don't have a down payment saved, right? What if you don't have a down payment saved as yet? There's several things I can say there. One is, obviously, you can just set a plan to save. What some people do is they borrow against the 401k for the down payment. In a lot of the cases, you can do that, and you repay yourself. We don't count that as debt in your debt ratio. because you're just paying yourself back from your money. But if you borrow against it, it's generally about 6% interest that you're paying back to yourself, so to speak. What you don't want to do is just extract money from the 401k, because that triggers taxes due and a penalty in most cases if you're not of age to pull from the 401k, of course. So I wouldn't just take the money out. I would borrow against it if you're going to go that way. Otherwise, for the down payment, you can have family give you a gift. A lot of times family want to see you into a home because they know it's going to build wealth, and they know it's a great thing for you, and they know you're just struggling to come up with the down payment, and they don't want to just give you money for just whatever, but they would love to help you out towards something that's lasting and going to help you buy a home. Another thing people do sometimes is just sell something. I've had people sell a boat or a Harley or something like that, and they say, that was fun, this is more important. You can do that. If you do, just keep documentation, a bill of sale, a copy of the title, things like that, so we can document where the funds came from. So you always want to source funds or season them. If you just sold a boat last week and you're closing next week, they're not seasoned. They're not in your account for 60 or 90 days. They have to be sourced. So let's talk through that if you're going to do something like that. The other thing people do is just work odd jobs for a little bit. And I've seen a lot of people do that. And there's nothing wrong with that. They'll deliver pizzas for 2 months and save up a little bit extra or something like that. And nothing wrong with that either. So those are a few ideas to come up with a down payment. There are down payment assistance programs as well. They have a lot of strings attached, and in South Carolina, they tend to be quite costly as far as increasing closing costs and things like this. So we can talk through those if you want. The really nice one is Freddie Mac has a new one. Freddie Mac requires 3% down payment, but you can get up to $2,500 grant towards your down payment just by being approved for the loan. It's that simple. And you have a little home buyer class you go through, which is about 45 minutes, and then it's done. You qualify for $1,500 or $2,500. We can talk through that as well. Let's see. What if? Oh, okay. Interesting question. On credit. So what if someone co-signs for someone else, right? You co-sign in a car, and then that other person goes delinquent, so it's reflecting on your credit report. That happens more often than you would think, and yes, it is a problem, because as soon as you co-sign on a loan for someone, whether it be a car loan, a student loan, or whatever it may be, as soon as you co-sign, you haven't just helped them out to get that loan, you've also taken 100% responsibility for that loan. So if the person you co-signed for that car loan with stops making the car payment, it's not that you're responsible for half or a quarter or part or not responsible at all. You're responsible for 100% of the car payment. Otherwise, it goes against your credit. That's why I'm not a big fan of co-signing for people. I'm just not. But and that's why I see that more often than not, that you co-sign for a daughter or a cousin on a car, that person stopped making the payment, and your credit is whack, and to no fault of your own, except it is, because you've agreed to co-sign on that anyway. So I would recommend you not co-sign. But that's the question. It's a good question. Is it really yours? And the answer is yes, it is. Because you signed on the dotted line and agreed to repay it if that person didn't. Cool. So what if, okay. Well, if you want to buy, that's an interesting question. This comes up more and more. I don't know if this is out there, financial gurus or something are saying this, but what if you want to buy a multi-family home, say it a different way, but a duplex or a triplex or a quad or something like that, and live in one unit? And this is something that a lot of people recommend for first-time buyers, right? You buy a home, say a duplex, you live in one side, so it's owner-occupied, but then you rent out the other side. And so you have some income coming in from the rent, it offsets your mortgage, and you live rent-free, or it's usually not rent-free in my experience, but it's pretty close. It really reduces your cost of home ownership because the rent offsets your payment a little bit. Yeah, you can do that. And you can do that most of the time owner-occupied with 3.5% down if you go with an FHA loan. So that's how I would generally recommend doing that. I would go with an FHA loan, not conventional, because conventional requires 15% down if it's a duplex, owner-occupied, and 20 to 25%, depending if it's Fannie Mae or Freddie Mac, if it's a 3 to 4 unit property, owner-occupied. So it's a little more stringent on the down payment on a multifamily for conventional, but it's not for FHA. So I would definitely go FHA, plan on 3.5% down of the entire purchase price, and then you can rent the other 1 or 2 or 3 units. It's a good way to go. It's hard to find in Charleston. Up north, they have lots of duplexes and triplexes and stuff like this. I think they do out west as well. We just don't. We don't have that many. So in theory, it's a great way to go. In practice, here in the Low Country, we just don't have that many from what I'm seeing. So, but it's a good question and a good thing to look at least. The other thing you can do, by the way, it's a little off topic, and I've seen people do this quite a bit, is just simply have a roommate. Now, you can't count that income as offsetting the mortgage, so you can't use it to qualify, right? So if you're going to rent out a room or 2 rooms for $500 a month each, you can't use that income to qualify for the home loan on a 1-unit property. But it is income coming in, so it really is offsetting your payment. So that's a good thing to at least consider as well if you're single, buying your own home, your first home, etc., and worried about the payment and want to just reduce costs. It's a good way to go. And how long is a pre-approval good for? So 2 ways to answer this question. The simple answer is the credit report is good for 4 months, 120 days, and then it expires. So if it expires and you haven't found the right home, we just need to pull a new credit report. So 4 months is a simple answer. The more realistic answer is how long is a pre-approval good for? It's good until nothing major changes, right? Credit doesn't go down or up majorly, you don't lose your job, the income doesn't change significantly, et cetera, et cetera. So it's 4 months as a credit report, but everything else is really so long as there's no significant change, you know. So, and if there is, and you're out looking for a home and you see something change, I've actually had this happen where someone got pre-approved, we wrote the pre-approval letter, we had verified income, assets, etc., and then they got fired. Well, it stands to reason that that changes things, right? Because the income just went away that we used to qualify you, but I had one person not say anything. So they wrote a contract with the pre-approval letter and then divulged, oh, by the way, I don't have a job anymore. Probably the information your loan officer and your realtor need to know as soon as that happens, because then you pivot and go to plan B, wait for the job offer and qualify again, etc. How long does it take to close a loan, to get a loan closed? I assume this question says, how long does it take to get a loan closed? Most of the time, you would write the contract for about 30 days. So from contract to close, 30 days. There's a couple of loans, USDA takes a little bit longer, so I'd write it for 45, just to be safe. And there's specialty loans like bank statement for self-employed, et cetera. I didn't even talk about that. They take a little bit longer as well, and a renovation loan, et cetera. There's certain loans that take a little longer. The vast majority take 30 days to close in general. So, and we are at a median of contract to clear to close of 24 days. But you want to leave that extra 6 just in case something comes up. There's a problem with the appraisal that needs addressing, or whatever the case may be. You want to leave a little cushion and a buffer there. So 30 days is generally fine to write a contract and get to a closing table. We can do it faster, but most people aren't in that big a rush, et cetera, so 30 days is fine. And asking about down payment assistance, I kind of answered that a little bit. Guys, I think that's pretty much all. I got a couple of repeat questions. I think that's about it. Thank you very much for your time this evening. I'm glad you spent the time, and we're coming up on an hour, 5 minutes short, so it's just about the right time to wrap. If I can do anything, here's my contact information. If you're ready to move forward and get approved for the home loan, let's do so. Give me a call. There's my number on the screen, and or shoot me an email, of course. And I'm hoping that you've done a lot of this and you're more confident going into just knowing what the process is and what the components are. when we boil it down to it, it is for getting approved for the home loan, first of all, it's credit, assets, and income. So if you boil it right down, it's credit, assets, and income. Those are the three things we mostly look at. And around there, there's other questions that come up, but it's all around those three questions generally. And then with the home purchase, it's, you know, property type and location, etc. But I would recommend, let's get approved for the mortgage first, because then you're confident of how much you can afford and how comfortable you are with that payment, and then start looking for the right home. Congratulations on taking the first step. I look forward to working with you. I know the realtor that invited you, if there was one that invited you, is really looking forward to working with you. And again, I would recommend you reach out to that realtor because they're handpicked. I didn't just send the links out for them to invite anyone to anyone. It was very much some of the most experienced and professional realtors in town. So I hope that helps. I will talk to you soon.